Good afternoon, ladies, and thank you so much for joining the session today. My name is Amal, and I'm a financial planner with RBC and have been with RBC for 25 years now. And thank you so much, Noreen and Farhan and Tula, for inviting me. It's an honor and a privilege to be able to talk to you about things that I've learned along the way and to help educate and empower women. Today's session is on wills and life insurance. And essentially what today's session is all about is really about managing your risk and how to protect yourself. So I'm going to go ahead and get my presentation up and share screens. Okay, and Noreen, please let me know if the presentation is not showing.
It's showing. Thank you, Mel.
Thanks so much, Noreen. Okay, so this is me. Again, I've been with RBC now for 25 years almost. The extent of financial planning and clients ask, what is the difference between, what you do and what other investment advisors do? And when you're talking to a financial planner, the key difference is that, after several courses and designations, what a financial planner will help you do is put together the key components of everything relating to your financial life and the components of risk. So what I do specifically with clients, sometimes it's retirement planning. We talk about taxes. We talk about estates and will planning. We definitely talk about the investments along the way. How do we protect you? What is risk management, cash flow and budgeting? We talk about borrowing and debt management. And also for business owners, we go through succession planning as well. So today's session, what we are doing specifically is focusing on risk management and estate planning. So what is the importance of a will? The will ultimately isn't mostly about who gets what. The importance of a will is the main and the biggest importance is naming your executor. And the way that I like to explain what an executor is after you pass, who will be your voice? Who is going to speak for you when you can no longer speak anymore? The executor is the most important part of your will. It also names your beneficiaries. So ultimately it is going to come down to who gets what. You get to specify who your beneficiaries are and when they receive the estate. And the number one thing also, this especially is for younger families. And my sister, for example, who I hope is on the line right now, and she has 4 younger children, and she doesn't have a will. And I keep encouraging her, and she says, well, I don't really have a lot of money. And is it really that important? I have RSPs and, everything goes to my husband anyway. And the importance is that your main asset, forget the house, forget the RSPs, is your minor children. To leave your children, God forbid, you get into an accident with your husband and your children are left alone. You need to specify who is going to take care of your children so that they don't end up in the courts. So it's not automatically assumed that your kids are going to be in the hands of the grandparents or your brothers or sisters. It'll eventually happen that way, but the courts will intervene right away and protect the children. So you want to be able to have, unfortunately, some of those hard discussions. And that would be the number one thing that I would caution younger families that feel that setting up a will is not so important because they don't have enough assets. But if you do have minor children, please take care of that right away. And also the importance of a will is making sure that the process is smooth. You don't want it to be tied up in courts for sometimes can be years. You want to be able to make those decisions and not have the courts decide things for you. So what happens when you die without a will? These are called intestacy laws. So when you hear the word intestate, it means that the person died without a will. And dying without a will, if you don't die with a valid will, the courts will decide who your executor is, and they call that the administrator. Now, typically what will happen is, let's say, for example, I died without a will. Somebody would come forward from my family and make an application to the court and say, I would choose to be Amal's executor. She doesn't have a will. And then the courts will decide if that's acceptable or not acceptable. Again, it will delay the process. And if nobody steps forward to claim it as the executor, well, then the courts will assign an administrator, and the administrator is responsible for paying off debts, your testamentary expenses. So these would be things like your funeral arrangements or cremation. And then the balance of it they will divide up the estate based on the provincial laws. So it's not automatically that you have a surviving spouse and then your spouse receives everything. That is not the case. If you have a surviving spouse, your surviving spouse receives what's called a preferential share. So it's not all of it, they will receive a preferential share. And then after they get that preferential share, then the balance is divided amongst your spouse and surviving children. And that may also mean surviving next of kin if you don't have children. So your brothers, sisters, mother, father. Every province has its own rules around preferential share, but just be cautious. Just because you're married does not mean that automatically everything reverts to your surviving spouse. If you die without a valid will and you don't have any surviving relatives, your estate actually goes back to the government, and that's called escheatment. And in my category, it's just called being cheated. All of the things that you've saved over the years. Even if you wanted to give it to, the dog shelter, it's not up to you anymore. It will go back to the government. So make sure you have a will. And then especially if you do have minor beneficiaries, the courts will also decide who the guardians will be. So keep in mind, again, it's not automatically your brother or sister or grandparents. The courts will actually decide on who the guardian is. And that falls under the family law. So a lot of clients ask me, well, is a holograph will, so this is a handwritten will or an online will kit, is that just as good? And holograph will, so where you do your will and you handwrite it and you sign it, you don't need any witnesses, is valid. Not all provinces validate it, but in Ontario, it is valid. And also the online kits, you can find hundreds, if not thousands of templates now on how to complete your own will for $39.95. In my opinion, something is better than nothing. So if, for example, you're going on vacation and you don't have a will and you realize, well, what would happen, if God forbid we got into an accident and there's nothing in place? Well, handwrite your will, have something in place for sure, or do one of the things online. But at the same time, in the case like this, what I would really say is whatever $400 or $500 that it costs you to sit down with an actual lawyer and plan out a proper will, do that. Save your Starbucks money for the next 3 months or 6 months and do a proper will. That $500 will be the best protection that you have to make sure that everything is drawn out properly, that it's thought out. I do this with clients, although I don't complete the will itself. We have a lot of will planning discussions around what would you do with all of your assets. And you get to have a little bit of give and take on giving you ideas and giving you stories of clients that I've dealt with before. But it really just opens up the conversation so that you can really start thinking about what does your legacy look like. Spend the $300, $400, $500, get a proper will done. And then you don't have to think about it again, unless, extenuating circumstances happen all over again. Another divorce or more children or something else happens where you feel like I really should update my will again. And what is probate? So a lot of clients panic about, oh my God, my will is going to be probated and I'm going to lose everything to the government. They're going to get half. So I need to dispel that. What probate tax is, probate essentially identifies who the rightful executor is. So I'm a banker, and when somebody comes to us and they say, oh, my father has passed away and he has $300,000 in a bank account, and I do all his banking for him, and we don't want to go through probate because you have to pay the tax. Well, the bank isn't going to release those funds. We're not just going to automatically say, okay, John, we've known you for a long time. Here's the $300,000. It's not going to happen. The banks are liable for dispersing the funds as to the wishes of the will. And if there is no will in place, or the will is not probated, and what probate means is that you take the will to the courts. The courts will confirm who the rightful executor is, who we're allowed to talk to, and then if the will is valid. So the court will stamp it. That's what the probate is. The executor comes back to the bank and says, here's the probated will. And now we can take instruction from the executor as to the division of assets and what do we do with the funds. And also to be noted that as soon as the will is probated, it now becomes a public document. So if you're curious and one of those, nosy people that wants to know what happened to so-and-so next door, they died, and now the will is being probated, you can actually go to the court and find out who the rightful beneficiaries are. You can search that document. It is a public document that's available. For clients that are very wealthy or clients that want more privacy, typically what will happen is we will set up trust accounts so that the trust does not go through the will and does not need to be probated. And this typically happens for very wealthy clients because they don't want people knowing, well, where the business is or where the assets are and who the rightful beneficiaries are. And to give you an example of, what probate tax costs. So in the province of Ontario, and these numbers are actually going to be updated in the next budget. So take it with a grain of salt that these are the probate taxes now, but I believe in April they should be changing. It's 0.5% on the first $50,000 of probatable assets, and then 1.5% on the balance over and above that. So to give you kind of like just a general idea, on $1 million estate, that costs about $15,000 in probate tax. It's not the be all and end all of taxes to make sure that your wishes are respected and that the rightful executor steps forward. But at the end of the day, you can definitely do things to minimize the probate tax on top of it. But it is not the be all and end all of trying to hide all of your money so that you don't pay any probate tax on it. And I'll talk about some of the pitfalls on trying to do everything joint with right of survivorship to avoid probate. So let's talk about what gets probated and what doesn't get probated. So let's talk about no probate first. And these are assets that already have named beneficiaries on them. So we're talking about your RSPs, your RIF accounts, your TFSAs, if you have segregated funds or life insurance funds, and joint with right of survivorship. All of these assets do not fall within your estate because they already have named beneficiaries on them. So if I have a joint bank account with my husband and there's $300,000 in it, and I die, my husband automatically receives the joint account without going through probate, joint with right of survivorship. Where a lot of clients get into pitfalls with this is when, let's say, parents have, their $1 million home, and they want to know that their $1 million home doesn't have to go through probate and they have to pay that $15,000. So sometimes they'll come to me and they'll say, well, what do I do to get my children on the house, on the deed? And it's definitely possible. You can definitely do that. But for the $15,000 that it costs you in probate tax, you now open yourself up to liability. So let's say your kid gets into a car accident and now they're being sued for liability. Well, your house is now partly their asset. Whether or not they win that in court and now you have to sell your house, typically wouldn't go that far, but you're talking about one hell of a nightmare to get through that. On top of that too, let's say, for example, divorce. So a lot of times the parents want to put the children on the cottage. And if that child is already married, well, realize that under divorce laws, under the Family Law Act, that spouse may be entitled to a portion of your cottage, even though you intentionally did not mean for that at all. So we have these long discussions. There's no right or wrong answer. Once again, it's just opening up the conversation so that when you decide on what you'd like to do with the cottage or your estate in general, you can actually think about it and think about what would happen if, and have those discussions with your lawyer and draw up a proper will. Assets that do require probate, so these would be non-registered assets, so investment accounts that are in your sole name only, investment accounts, again, in your sole name only, as well as real estate, so your home. So if you own your own home and you don't have a joint owner on it, that home will go through probate, because the banks will not receive a check because you sold a home for $1 million and say, oh, well, let's just divide it amongst the children. It's not going to happen. The banks need to know who the rightful beneficiaries are, and that is defined by the probate and who the rightful executor is. And this is why choosing an executor is probably one of your most important decisions when it comes to will planning and estate planning. I like to, again, one more time, this is the voice for you when you can no longer speak anymore. Who is going to be able to say it the way that you would say it? Who's going to be able to do it the way that you want to do it? They're going to take care of your burial and your funeral arrangements. They're going to put together an inventory of all of your assets. They're going to make the application for probate. They're going to pay off all of your debts and expenses. They need to have direct communication with all of the beneficiaries. If the beneficiaries have any disputes, it's going to go through the executor. The executor needs to make the final tax filings as well as the clearance certificate. So they're going to make the application for a clearance certificate to tell CRA all the taxes are paid, and now I can finally disperse all of the assets amongst the beneficiaries. The executor can also be personally liable. So remember that as well as trying to name your executor. You have to realize that they can be personally liable. If one of the beneficiaries comes forward and says, no, you didn't invest the assets properly, or you lost $30,000 investing mom's money, you can actually be personally liable as an executor. So make sure you choose an executor who has capacity, somebody who's smart, who knows what they're doing. They have the time, because it is a lot of legwork. It's a lot of paperwork. It's a lot of legwork. Somebody who's close by, who can communicate with the beneficiaries on a regular basis, and who you ultimately trust to carry out your final wishes. You can also consider what's called a corporate trustee. A corporate trustee, all of the banks have them. So let's say Royal Bank has the division of Royal Trust. And what a corporate trustee will do is they will be named in your will as the executor, and they will handle all of this. They will take a fee, absolutely, but they will take care of all of this for you. And what is a testamentary trust? So again, especially when it comes by way of protecting minor beneficiaries, also disabled beneficiaries, maybe there's a second marriage, so you don't want your second spouse to receive all of the assets. You want to make sure that there's a portion for your children and a legacy for them. These are all contained in what's called a testamentary trust. I'm being very mindful of time. I'm sorry, I didn't realize that we're almost at the 20-minute point here, so I'm going to go a little bit faster. A power of attorney sometimes is the same as the executor, except that the power of attorney is while you're alive, and executor is when you're dead. So you want to name 2 powers of attorney. This typically will go hand in hand with when you're doing your will. You want a power of attorney to deal with your property, so all of your financial assets. And then you need a power of attorney for care. And ultimately, that's somebody who's going to take care of when you're sick, but also, I hate to use the expression, who's going to pull the cord to say, okay, this is time for mom to go now. And that would be your power of attorney for care. So you need someone, again, who is trusted, who has capacity, who's somewhere close by, and typically somebody who may be younger. You don't want to name your father as your power of attorney. You want somebody who's going to outlive you typically. And on to insurance. I know we're at the 1 minute mark. Noreen, if you're on the line, am I able to extend it another 5 minutes or do I need to cut off? Okay, I'll keep going until the line disconnects. So let's talk about insurance now. Again, we're talking about risk management. Life insurance comes in two different parts. You have term and permanent insurance. I'm going to keep going by a little bit faster. So term insurance, you typically buy a term. It's 10 years, 20 years, 30 years, 50 years. And ultimately the insurance is as good as long as the term that you choose. The premiums stay the same. So throughout the 10 years or 20 years, the premiums will stay the same. And you have the option to renew. Sometimes that can be at a premium because obviously you've gotten older. So as you get older, insurance goes up. Insurance companies are banking on the statistics of when you're going to die. So as you get older, of course, you're going to die. That's just a fact of life. We all die. So getting insurance as you get older is definitely more expensive. My advice to clients is try to start getting insured at a younger age. Yes, it's an extra cost for you, but having an insurance policy that starts earlier rather than later is definitely a very good option. Permanent insurance, or what we call whole life insurance, is set for life. So you pay the premiums all the way throughout. The premiums stay the same. But typically there's something what's called an investment portion inside the insurance policy. So almost works like a mini RRSP, if you will. It's not an RRSP, but typically it just gathers investments as you build the insurance policy. Disability insurance, keep in mind that the probability of being disabled is 6 times more likely than dying young. So if you think you don't need disability insurance, think again. Disability insurance is definitely very important, especially when you're the main breadwinner in the home. So think about what would happen if something were to happen to you. Do you really want to sell the house because now you can't afford the mortgage payments anymore? You really need to consider things like workman's comp only covers if you were injured on the job. And EI only lasts for 15 weeks. So what happens beyond that? You need to do a calculation to say, do I have enough for 6 months to a year of income to make sure I support my family's life if I'm the major income earner? Critical illness gives you a lump sum payment. So if you fall seriously ill, something like cancer or heart attack or stroke, it gives you a lump sum right away. And what that enables you to do is, let's say, do renovations on the house if you need to build a ramp, if you need an elevator, if you need a wheelchair. Those are things that critical illness will be able to afford for you. Again,
I am so sorry to interrupt, Amal. Your allotted session is now completed. I am so sorry.
It's all good. I tried. You can go ahead and if anybody needs to reach out to me to see the remainder of the presentation, absolutely, I'm available anytime. Thanks, Noreen.
Thank you very much, Amal.
My pleasure.